Hey, this is Arthur Hill, and you are tuned into Next Level Charting. Today, we're going to take a look at the 20-plus year Treasury Bond ETF, and we've got three reasons for watching this one. The first is that 2019 was year of the falling wedge. We saw a number of falling wedge breakouts and some really nice extensions after those breakouts. Second, TLT has a big falling wedge taking shape, so I'm watching that breakout closely. And the third reason has to do with its possible effect on the stock market, because bonds, of course, represent the ultimate safe haven, and if money starts moving into safe haven assets, it could detract from riskier assets like stocks. Let's hit the charts. So as noted, 2019 was year of the falling wedge, and there were a number of them that formed, some in the fall and then some later, like this one in XLRE. And the idea behind the falling wedge is that it is a corrective pattern. I know people use them as bottoming patterns and rising wedges as topping patterns, but I don't use them that way. Basically, what you have is you have a big advance, and you're entitled to a correction after that advance, and that falling wedge is a corrective pattern. And so I showed XLRE last week hitting the 200-day, which is rising and breaking out of that wedge, and that is a bullish development for XLRE. Now that's one of the later wedges, but the big wedge breakouts came in some of the tech-related ETFs, and these were pointed out at trendinvestorpro.com when they were happening in October and November. So here's the cloud computing ETF. It had a big run, kind of went sideways, and then it got kind of wedgy here, where you have the lower high and the slightly lower low, but those lines are slightly converging. And what you can also see is that from that December low to the high, this retracement was 38 to 50%. So the falling wedge and the retracement, 38 to 50%, are typical for corrections within bigger uptrends. And we got the breakout here. And what's also interesting to note is the 200-day never turned down during this period. The 200-day was always rising there. And when you got back above the 200-day the second time there and above that wedge line, that opened the door to a move higher. Now, the other wedge that we had was in the FinTech ETF, and it, of course, is related to technology. Massive move, 50% advance. You're entitled to a correction after that. And so you correct with a falling wedge that, again, retraces 38 to 50%, the garden variety correction, if you will. It's kind of like two steps forward with this big 50% advance. And then the falling wedge is one step backward. And as long as you're, making that 1.5, 2 steps forward and only going back one step, you're making progress. You're in an uptrend. And that is kind of reflected in the 200-day, which again was always rising when the falling wedge formed. So even though prices moved lower from August here until October, the wedge was falling, but the 200-day was rising. And that was more definitive of the longer term uptrend. So we got the breakout there, we got a mini wedge there, probably more like a pennant because it's short term, and then the breakout there, which of course was duly pointed out on, the name of the website by now. So the other one we had was the software ETF, and this is IGV, and what a leader it has become. And what's also interesting is when you're watching IGV here, and at the end of October, they're lagging. All right, the S&P 500 is breaking out to new highs in the later part of October, and IGV is below its 200-day moving average. So it's showing relative weakness. It's below the 200-day, but you got to look at the structure of the price chart. And if you look at the structure of this price chart, again, you can see that 45% advance, 2 steps forward, 1 step backward. The 200-day is still rising. So even though it's negative, it's very interesting here when it gets down in that 205, 210 area and starts to firm. and then we get above the 200-day, and then we get the wedge line break, and then we get the break above resistance, and boom, we get the big move higher. Now, the only concern I have here for the market is, man, it has been like shooting fish in a barrel since October. We have had a 4+ month run where it has been pretty easy to make money, and it doesn't always last, and there's going to be some harder times coming. I don't know when, but this has been an extraordinary run, and we're getting ready for maybe a correction. Now, the other one here, this is GDX. I'll just go over that one quickly. There you can see the wedge and the breakout. It's still in the works. And then gold. Gold was another wedge breakout in late December on the 24th, as a matter of fact. All right, huge move up, 23%. And you say huge. Well, the other ones were 50%, but you know, gold is gold. And then 38% retracement, normal pullback, falling wedge, and the breakout. And yeah, you didn't have much time to react because you had to catch it right away, or you could nibble in here anticipating a breakout, because once it happened, it just surged to a new 52-week high. But now you know the theory behind the falling wedge and how I like to use it. So I was going through the charts and I came across this chart for TLT, and I know what these wedge breakouts produced in 2019. I know the theory behind the pattern. I know that they're corrective patterns after a big advance. And I look at this chart for TLT and you can see that it is a picture perfect falling wedge. If you look at the first advance, you know, this is a massive move in TLT from 112 to 147. And for a bond, that's a big move. And this is unadjusted data. I've got the little underscore before the symbol. So after that big move, you're entitled to a rest. You can't sustain that kind of advance. And one thing to note is, look at how the advance accelerated here. And that acceleration was the danger signal that things were getting way frothy. And then you had a spinning top and the big decline. So now we've corrected and we've worked off the excesses. It took a few months, but TLT worked off its excesses with the falling wedge, retraced 38%, which is normal. So you got basically 2 steps forward and less than 1 step backward. And then now you can see we're firming and we're moving above that wedge line. Now I've got 2 indicators that I want to spotlight. One is to define the trend, and the other one is to look for some sort of momentum breakout, if you will. And the first is RSI, and I'm just using, you know, normal 14-week RSI. This is a weekly chart. And its bear range is typically between 20 and 60. So there is roughly 20 and there is 60 there. And so when we're in this 20 to 60 range, you can see prices are trending lower because that's weak momentum. You can't get RSI above 60. But finally we get above 60 with the green line here. And that corresponds with a that's a 52-week high intra-week. Almost. It's a multi-month high there, but that's definitely a 52-week high in March with the breakout there. But RSI changed, okay, here. And it's moved into its bull zone, which is from 40 to 80. And you can see it's come down into this 40 to 50 zone, right around 50 since October. So even though the wedge was working there, RSI was trying to firm here in that 40 to 50 zone for several months. And you didn't see downside momentum continue. All right, you didn't get that push below this low. You actually held above it slightly. And so that tells me that RSI is in a bull range, and that is still longer term bullish. And so then I turn to my Stoch RSI indicator. Actually, it's not mine. It's Tushar Chande, who developed Stoch RSI. He did it with Stanley Kroll. And what's great about Stoch RSI is it puts a little Red Bull into RSI because, and that's the way why they created it, because RSI wasn't generating signals as much as Stanley and Tushar wanted, and so they wanted to juice it up a little bit. And so this is the stochastic oscillator applied to RSI. and I'm using 14-week. And so basically what I'm looking for is Stochc RSI to surge above 0.80. And that tells you that RSI is hitting or near a 14-week high. And that's some sort of momentum uptick, especially when RSI is near that low end of its bull range, which is quasi momentum support, if you will. But look at this. We're getting that bounce. We're almost above 0.80. So we're almost on the verge of a Stochc RSI or momentum breakout here. And so I think that bodes well for TLT. So here's a daily chart just for a little more granularity. And when you go back to those wedges I showed you in, say, for software, all right, you basically had a multi-month decline, but they were above the rising 200-day moving average or near it. Software dipped below it, but fintech was, the 200-day was still rising. And that's what's happening here. You've got this multi-month decline, but the 200-day is still rising. You've held above this November low here in late December, and TLT is breaking out here on the daily chart. So I think this is a bullish breakout, and if you go below the 200-day, then I think you would have to reevaluate. So how might this affect the stock market? Well, first of all, I don't want to get too much into this intermarket stuff because I think, the effects of the dollar are seriously exaggerated. I don't think the dollar is that big of a player. I know I can get a lot of feedback on that, but forget watching the dollar, I think. If you want to watch the stock market, watch the stock market, okay? Don't take your cues off of bonds. If you want to watch the bond market, watch the bond market. Now, what we did have here was, here they were living happily together. You had a big move up in SPY, and you had a big move up in TLT. But then we got this divorce here in August, and we had SPY continuing higher, and we had TLT moving lower. And this kind of makes sense because you basically have money moving out of safe haven bonds, which is represented by TLT, and you have money moving into riskier assets, which would be SPY. And we can see that down below. You had the 13-week rate of change for SPY. It's been positive since February. And the 13-week rate of change for TLT was positive until late October when it turned negative. So money clearly was moving out of these safe havens and into riskier assets. But now we're starting to see money move into safe havens, bonds. And so stocks are getting pretty frothy. And that's why I'm watching to see if the next move might be money moving out of riskier assets. I'm not looking for a bear market or anything, but we are entitled to a correction after such a big advance. So TLT on that weekly chart looks like it's on the verge of a pretty important breakout. Now, past performance does not guarantee future performance, but if you look at the price structure of that chart, it looks bullish overall. And a breakout in bonds could detract from stocks going forward, and we could get that long-awaited correction. So I appreciate you taking the time to tune in to Next Level Charting. Have a great day, and I'll talk to you again next week.